Up now, we have Forum Daily's market update with Catherine Murray.
Thanks, Nima. Hello, everyone, and welcome to your weekly market recap. I'm Catherine Murray. We are seeing markets rally today, but it has been a very volatile week and a half, essentially, really due to the Silicon Valley Bank bailout or backstop. And after that, all eyes were on the U.S. Federal Reserve's rate decision yesterday, which came in as expected. They raised rates by 25 basis points. Keep in mind that going back only 2-3 weeks ago, prior to the SVB collapse, investors were believing that the U.S. Federal Reserve would raise rates by 50 basis points. They lowered those expectations, thinking that the U.S. Federal Reserve recognizes how aggressive tightening has impacted the banking system. And therefore, investors lowered their expectations. So they came in and raised rates by 25 basis points in line with consensus. Now, the original takeaway in the market was that this was a dovish move and likely the right move, again, given the tightening in the banking system. And the markets rallied and yields declined. But then there was a real reversal in the market performance yesterday, likely not having to do with the U.S. Federal Reserve, but rather what Janet Yellen said. And she came out and said that the U.S. is not considering blanket insurance for all bank deposits. And I think that's what caused the markets to decline. Today, we're off to the races once again because I think that the Fed is the driver of the markets, and the takeaway is that the comments were in fact dovish. Fed Chair Jerome Powell said that additional policy firming might be appropriate. That's kind of walking back some of the aggressive talk that they've had over the past number of months, and certainly over the past year, where they've raised rates by 500 basis points or 5%, which has actually been very rare historically. So in other words, very aggressive tightening. Obviously, we're seeing that in the banking system and the cracks. Going back, just real brief here, Silicon Valley Bank, they bought long duration assets that had significant unrealized losses. And then they had to take the hit on that. It spooked investors, and it caused everybody to go and look at the bank balance sheets of other banks. And many people would say there's more to come. That aside, as we look at the markets today, as I mentioned, we are in rally mode. But I'd also just say that I think we're still at the early stages of understanding the bank turmoil and the impact that that's had on the market, not only just the market, but the lending environment. We likely will see the lending environment tighten. It's already been tightening. But that also might keep the Fed and likely the BOC at bay, just given the fact that the bank system itself is doing a lot of the work versus raising rates. So in other words, we might not need to see the rates rise. The banks are going to likely pull back on the lending. That does dampen demand, and it dampens economic growth. Looking at the markets today, we are seeing gold up by 1.5%, Bitcoin up by about 2.7%. WTI is down, but we've seen it up by about 2% yesterday. All sectors in the United States are higher. We're really seeing those tech stocks take off. They've been in massive rally mode. Remember, what happened last year was rates were rising, the valuations of tech stocks were declining. Now it looks like that trade might be reversing, right? We're seeing the rates decline. We're seeing expectations that we've seen peak rate hikes. In other words, rates are going to stay at this current level potentially, and therefore that gives rise to the valuations of tech stocks. We're also seeing home builders in the United States perform well on the back of KB Home's better than expected results, and the flight to safety stocks, I think consumer staples, etc., are the underperformers in the market. As we look at the TSX, it is trading higher today. It was down by about 0.6% yesterday, on track for some weekly gains following 2 big weeks of declines. TSX down by about 6% over the past 2 weeks. The BOC, the Bank of Canada minutes, came out yesterday. I'd say one takeaway there is that the risk of inflation staying above 2% is a concern. It might be a little bit more sticky, the inflation number here. But essentially the minute's a bit of a non-event. Tuesday, we did have the February CPI coming in a little bit cooler than expected. So in other words, maybe rate hikes here in Canada have peaked. We will be watching for retail sales this Friday just to kind of get a gauge of the Canadian consumer. Biden, of course, arrives in Canada, but some would say that the China interference developments are overshadowing that visit. In terms of stocks here in Canada, Bombardier, that stock's up by about 8%. They did update their 2025 strategic outlook and their fiscal targets a little bit higher than expected. And lastly, just in terms of SVB and what it means to Canada, the Canadian banking group is calling on Ottawa to review the deposit insurance. Remember, here in Canada, you're covered for $100,000. In the United States, it's $250,000. And again, just some SVB, Silicon Valley Bank fallout. We'll see whether or not TD does go through with the First Horizon deal. Nima, I'll leave it there. Back to you.